On February 3rd, 2026, $285 billion in market value evaporated across the highest performing SaaS industries in a single trading session. LegalZoom, the gatekeeper of digital legal filings, saw its stock crater by 20%. HubSpot, the CRM giant for the mid-market and enterprise, fell by 12%, and Thomson Reuters, the gold standard for professional informational software, suffered a 16% drop, its largest one-day loss on record. The culprit? A research preview released weeks earlier on January 12th from Anthropic called Claude Cowork, an AI system that lives on your desktop and behaves like a human user with an end goal. It can read and edit files, navigate software, and even send emails to deliver an outcome. Claude Cowork turned heads across the tech industry on release, but the real panic didn't hit until January 30th, the day a series of open-source Cowork plugins were announced.
I can tell you, in 25 years, this structural sell-off in software is unlike anything I've ever seen.
A few other software names falling sharply to start the week again as AI disruption fears pummel the sector.
These plugins gave Cowork something much more dangerous than general intelligence: domain-specific knowledge to step into real functions like sales, marketing, analytics, and legal work. The legal triage plugin in particular set off alarm bells. Suddenly, an AI agent could scan contracts, flag clauses, triage NDAs, and even automate parts of compliance work that companies had traditionally paid humans and SaaS vendors to handle. This triggered an explosive market sell-off for SaaS stocks, especially for software built around professional services like legal and compliance. Wall Street bros would describe this as a grey rhino event, a massive, obvious threat that everyone ignored until the moment of impact. And that impact was pretty clear. By the end of day on February 3rd, the S&P Software and Services Index had lost 25% of its value. Claude Cowork feels like an existential threat to SaaS because this is no longer just AI you chatted with. You give it an end goal like preparing a sales forecast for an end-of-quarter meeting, and it carries out the work needed to get there. It reviews the pipeline in Salesforce, spots stalled enterprise deals, pulls the relevant context from notes and records, updates the CRM, and finally generates a tailored forecast for the meeting. And that's the real shift. We've moved from AI as a passive assistant to AI as an execution layer. Systems that don't just draft emails but navigate files, use software, and complete multi-step workflows to produce outcomes. And when you pair Claude Cowork with Claude Code, Anthropic's purpose-built AI tool for software development, the threat to SaaS snaps into focus. AI can now help build the software, and it can work within that software to handle white-collar business tasks. In other words, if a cheaper AI agent could both build and operate the software that businesses were charging thousands a month for, wasn't the entire SaaS model suddenly in trouble? This fear sparked the SaaS apocalypse narrative currently tearing through social media. But does a world of vibe-coded features and AI-run workflows really mean SaaS is dying? To answer that, we first need to understand how SaaS made money and why AI is suddenly making parts of that business model look dangerously fragile. For 20 years, SaaS was the undisputed king of the tech gold rush. The playbook was simple: take a messy business problem, create software that solves it, host that software in the cloud, and charge customers every month to use it based on their number of users or seats. The model was powerful because the unit economics were beautiful. Sure, building the product was expensive upfront, but once it worked, it scaled like no other business could. This created the golden trifecta venture capitalists and founders love. High recurring revenue, a subscription model means money hits the bank every month. High gross margins from leaner operating costs, adding hundreds or thousands of users costs very little. High predictability, you can forecast growth years into the future. For the customer, paying for a SaaS tool was a no-brainer. Instead of hiring an army of expensive engineers to build and maintain a customer relationship management tool from scratch, you bought HubSpot software. It saved you from stitching together sales pipelines, financial data, and email tools yourself. You paid the subscription cost, and suddenly, you weren't chasing down lost leads across dozens of spreadsheet tabs. Instead, you were closing deals from a single dashboard. And that's why companies like HubSpot are the textbook SaaS success story. In 2025, they cleared $3.6 billion in subscription revenue across nearly 300,000 customers. That's the lore of SaaS. Once you're in, you stay. The product gets stickier, accounts expand, and revenue just compounds. But underneath that law sat one huge assumption that until now, no one ever challenged. The assumption that a human would always be the one using the software and clicking the buttons. A marketer would log in to build a campaign, a sales rep would update a deal record, a support manager would route a ticket. We built these slick dashboards because humans have eyes and fingers. We need buttons and menus to tell the software what to do. But here's the thing, an AI agent doesn't need eyes, menus, or dashboards to get work done. It goes straight to the machine-readable layer underneath the dashboard, communicating through APIs and system integrations. Think of an API as a dedicated data pipe that lets two different programs talk to each other directly in raw code. When an AI agent handles the work, that slick interface you're paying for loses value, because the agent bypasses the interactive layer and goes straight to underlying data and logic. Suddenly, an essential platform starts looking like an expensive interface that few humans even need to see. That distinction matters because if a product's value sits in proprietary data, deep workflow coordination, and system-level integration, the SaaS product still has a moat, because it's the system of record. But if your value is just giving users a nice way to click through repeatable tasks, you start looking less like a platform and more like a thin middle layer between the user and the workflow. And AI is coming directly for that layer. Even the giants see this coming. HubSpot is already pivoting to AI agents and credit-based pricing. Their Breeze agent was resolving over 50% of support tickets by mid-2025. Think about what that means. The definition of a user just changed. It's no longer a human staring at a screen, it's an autonomous agent executing under the hood. So the real question isn't whether SaaS is dead, it's whether software is valuable enough to survive a world where the human user starts disappearing or is simply doing less of the work. To see which SaaS is truly at risk, we need to break down the product into key layers, because once you strip away the branding, not all software is built the same. One layer in particular is a prime target for AI, while deeper layers are harder to displace. At the top, you have the interface layer, the human-facing part of the product that people see. The dashboard, the buttons, the reports, the forms, the workspace employees log into every day. Underneath that sits the workflow layer. This is the traffic controller, where the software decides what happens and where. Assign this lead, route that ticket, trigger this email, move this deal to the next stage. And deeper still is the real core, the system of record. This is the vault. This is the place where the business stores critical data, permissions, approvals, audit trails, integrations, and all the messy logic that keeps a multi-million-dollar company consistent. For years, SaaS companies bundled all three together and sold them as one seat, and it worked brilliantly. But AI doesn't attack every layer equally. It eats from the top down. If an AI agent can understand the goal, bypass the interface, and trigger an entire workflow, the top layer starts losing value very quickly. And that gives us a more realistic way to think about the SaaS apocalypse narrative, not as one giant apocalyptic extinction event, but as a large-scale brutal stress test that puts SaaS tools into two categories. Shallow SaaS, software that's value is mostly in the interface, a cleaner dashboard, a nicer workflow, a faster way for humans to click through things and complete tasks. This is the danger zone. And deep SaaS, software that's embedded into the core of a business. This is much harder for AI to dislodge. Deep SaaS gets its value from layers downstairs, from owning critical data, from coordinating teams, from permissions, compliance, integrations, reporting, and all the invisible logic a business actually depends on. That's why we're seeing the first cracks usually show up in software that lives closer to the surface. Tools built around routing information, summarizing content, moving documents, or helping humans click through repeatable tasks. Take DocuSign. For a decade, they were the gold standard for interface SaaS, taking a messy document workflow and turning it into a clean, trusted signing experience. But the market is just starting to realize that signing a document is just a surface-level task, not a deep system. Despite solid results, their shares were down 30% earlier this year. DocuSign knows the old surface layer is a target. That's why they are frantically pivoting to intelligent agreement management and trying to move deeper into the logic layer by becoming the system that actually understands the contracts, not just the one that signs them. Then there's the red alert real-life example, Qualtrics. This month, banks actually halted a planned $5.3 billion debt sale tied to the company. Why? Because investor demand cooled specifically due to AI concerns. The market is betting that an autonomous agent can observe customer behavior and summarize feedback better and cheaper than a high-priced survey dashboard. And that's the pattern. From legal triage to customer feedback, if your product is just a pretty way to route info or summarize text, your business is vulnerable, and AI is a real threat. And responding to that threat looks like repricing, strategic pivots, and a scramble to move deeper into the customer's tech stack. This is where the SaaS apocalypse narrative really gets interesting, because while the interface layer is burning, the deeper foundations are stable. Surviving in the AI era isn't about being user-friendly, it's about being impossible to delete. If we look at a company like ServiceNow, it doesn't just help an employee click through tasks, it coordinates the entire nervous system of a giant corporation. Deep SaaS like this has DNA that AI can't replace. That's why SaaS companies like ServiceNow aren't panicked. They aren't betting that AI will make them irrelevant. They're betting that AI will have to work through them. So if shallow SaaS gets squeezed and deep SaaS survives, what's really happening in the industry? SaaS isn't disappearing, it's changing state. For 20 years, we bought software based on seats. One human, one login, and one monthly fee. That model only worked because the human was the one doing the work. But when an AI agent can do the work of many users, per-seat user pricing starts to look outdated. HubSpot themselves is moving towards credit and agent-based monetization. Intercom is charging for successful AI resolutions, and companies like Oracle are redesigning their product around a different assumption that AI won't replace enterprise systems, it will operate through them. If you're paying attention, the shift is clear. We are moving from seats to outcomes and credit and token usage, from tools humans operate to infrastructure that agents run through. That is the real SaaS apocalypse. It's not the end of software, it's the end of software that was mostly interface, mostly convenience, and mostly just one prompt away from being replaced. AI isn't killing SaaS, it's just exposing who was shallow SaaS all along.